Module 1, Understanding Credit Reports. Beginner Level Lesson 1.1, The 3 Credit Bureaus Explained. This lesson takes about 5 minutes to listen to. Introduction, Welcome to Credit Fundamentals. In this course, I'm going to give you the foundation you need to understand your credit, repair it when necessary, and build it the right way. Let's start with the basics. The 3 Credit Bureaus. The 3 Credit Bureaus. In the United States, there are 3 major credit bureaus that track your financial history. They are Equifax, Experian, and TransUnion. Think of these bureaus as 3 separate report cards that follow you throughout your financial life. Banks check them, landlords check them, employers and insurance companies check them. These reports help decide whether someone wants to do business with you. A critical insight. Here's what most people don't realize. Each credit bureau operates independently. They do not share information with each other. That means your Equifax report might look different from your Experian report, and both can look different from your TransUnion report. This matters more than you think. When you apply for a mortgage, the lender might pull Equifax. When you apply for a car loan, the dealer might pull TransUnion. Different reports mean different scores, and different scores mean different approval odds and different interest rates. Bureau Overview. Let's briefly look at each bureau. Equifax is the oldest, founded in 1899, with headquarters in Atlanta, Georgia. It's known for detailed employment history data. Experian was founded in 1996. Its global headquarters are in Ireland, with U.S. operations in California. Experian is known for having very comprehensive consumer data. TransUnion was founded in 1968 and is headquartered in Chicago, Illinois. It's widely known for being the most responsive when consumers dispute errors. Key takeaway, your credit is not just one number. It is 3 separate reports from 3 separate companies. And each one can tell a slightly different story about your financial history. That's why monitoring all 3 credit reports is essential, not just one. Action step before moving on. Take a moment to reflect. Write down which credit bureau you believe you checked most recently, and make a note to pull all 3 credit reports. We'll show you exactly how in Module 3. Lesson 1.2, Reading Your Credit Report. This lesson takes about 6 minutes to listen to. Introduction. Now that you understand the 3 credit bureaus, let's talk about what actually appears on a credit report. When you first pull your report, it can feel overwhelming. There are pages of numbers, dates, and account details. But once you understand the structure, everything becomes much clearer. The 4 sections of a credit report. Every credit report has 4 main sections. Let's walk through them one by one. Section 1, Personal Information. This section includes your name and name variations, current and previous addresses, your social security number, your date of birth, and your employment history. This section does not affect your credit score. However, errors here can still cause serious problems. If your name is misspelled or an address appears that you've never lived at, it could signal a mixed credit file or even identity theft. Section 2, Credit Accounts, also called trade lines. This is the most important section of your credit report. For each account, you'll see the creditor's name, the account type, the date it was opened, the credit limit or loan amount, your current balance, your payment history, and the account status. This section is where most of your credit score comes from. Late payments, high balances, negative account statuses. All of them show up here. Section 3, Public Records. This section may include bankruptcies, tax liens, and civil judgments. These are some of the most damaging items that can appear on a credit report. A bankruptcy, for example, can remain on your report for up to 10 years. Section 4, Credit Inquiries. There are 2 types of inquiries. Hard inquiries affect your score. They happen when you apply for credit, stay on your report for 2 years, and too many can raise red flags. Soft inquiries do not affect your score. These occur when companies check your credit for pre-approval offers, when you check your own credit, or during employment background checks. Key takeaway, the credit account section is where the majority of your score is determined. That's where you should focus first when reviewing your report and looking for errors. Action step before moving on, do this. If you have a credit report, identify which section each item belongs to. Then look closely. Anything unfamiliar or incorrect deserves your attention. Lesson 1.3. What hurts versus what helps your score. This lesson takes about 6 minutes to listen to. Introduction. Not all credit actions are created equal. Some behaviors can severely damage your score, others barely move the needle. Let's focus on what truly matters. What hurts your credit score most? The most damaging factor is late payments. A single payment 30 days late or more can drop your score by 60 to over 100 points. And it stays on your report for 7 years. Collections are also extremely harmful. Even small balances can lower your score significantly. Bankruptcy causes the most severe damage. It can drop your score by over 100 points and remains on your report for up to 10 years. Foreclosures also cause major damage and stay on your report for 7 years. Moderate damage. Factors. High credit utilization, meaning balances over 30%, can reduce your score. The good news is this damage reverses quickly when balances are paid down. Closing old accounts can also hurt your score by reducing credit age and available credit. Too many hard inquiries in a short period can make lenders view you as risky. What helps your credit score most, the single most important factor, is on-time payments. A perfect payment history builds and protects your score. Low credit utilization, ideally under 10%, can add 20 to 50 points. Removing negative items can create some of the largest score increases. This is where credit repair has its biggest impact. Moderate boost factors. Keeping old accounts open helps your score over time. Having a mix of revolving and installment credit strengthens your profile. Becoming an authorized user on a well-managed account can provide a noticeable boost. Quick wins you can do today. Set up automatic payments on all accounts. Pay down credit cards below 30% utilization and ideally under 10. Do not close old accounts even if you stop using them. And pause new credit applications while repairing your credit. The golden rule, payment history accounts for 35% of your score. Credit utilization accounts for 30%. Together, they make up 65% of your credit score. Focus here first. Everything else comes second. Final action step before moving on to the next module, check whether autopay is enabled on all accounts. Calculate your current utilization and identify your oldest account. Make sure you keep it open. Closing. You've now completed Module 1. You understand how the 3 credit bureaus work, the 4 sections of a credit report, and what hurts versus what helps your credit score. Next, we move into Module 2, the FICO score breakdown.